In this video, we're going to take a look at the right strike price to buy for your option. Picking the right strike price has everything to do with how fast the stock is trending. And by the way, you never want to buy an option on a stock unless it is trending, and fairly strongly at that. The reason is that trend or movement is where you're going to make your money. So assuming in looking at the chart, you've got a nice trend in place, the key is how fast the stock is moving and the likelihood it will hit your projected target. That likelihood is not only dependent on the current trend, but also on what's coming. For example, if everyone knows a certain stock tends to exceed their earnings expectations and the company's earnings date is, say, 3 weeks away, there's a good chance the stock will trend higher into that date. So you use that combination, a current uptrend along with a date or event for the stock to rise into, and you have a reasonable expectation of the stock rising for the next 3 weeks or so. Picking the correct strike price works like this. If the stock is trending fairly quickly, you can buy a strike price that's a little out of the money because it's relatively cheap and the stock will likely go past it, quickly adding value to your position. But if the stock is trending in more of a slow, steady fashion, then buy a strike price that's in the money. Also, if you don't have a lot of time left until expiration, buy in the money so any increase that you do get will have a greater impact on the option price. Here's why. The amount an option price moves is in direct relation to where it is in relation to the stock price. Here's what I mean. If you're looking at a call option and the strike price is lower than the stock price, the option is said to be in the money. If the stock price and the option strike price are the same, the option is said to be at the money. If the strike price is higher than the stock price, the option is said to be out of the money. And that's important because of how the options formula works. If the strike price is above the stock price, in other words, out of the money, the option will go up in value at a fairly low percentage compared to the stock. For example, if the stock goes up $1, the option might go up 30 cents. The amount the option goes up is called the delta, which is always a percentage of a dollar. In this case, the option has a delta of 30 or 30 cents. But here's what's cool. As the stock price rises toward the strike price, the delta goes up. Say it's 30 when you buy it, and then as the stock rises, the delta rises to 35 and 40, then 45, and finally, the stock price has risen so far that it's the same price as the strike price. At that point, the option is said to be at the money. And the options formula tells us that when the stock price and the strike price are the same, the delta is 50. In other words, the options price goes up 50 cents for every dollar the stock price goes up. So as the trend continues and the stock keeps rising, it goes higher than the option strike. The delta continues to rise so that now if the stock price goes up $1, the option goes up maybe 60 cents. And the delta continues to go higher the further the stock price climbs above the option strike. So from a trading standpoint, you can make a lot of money by buying an option that is out of the money and watching it become in the money. And you need it to become in the money because if the stock goes to expiration and it's still out of the money, that option becomes worthless. That's how a lot of people have lost money trading options, and it's something you obviously want to avoid. So if you're super confident of the speed of the trend, you can buy a little out of the money to get a bigger bang for your buck. But if you're unsure at all, buy in the money and always buy more time than you think you're going to need. In fact, that's the subject of our next video, time decay, that powerful X factor that separates stock trading from options trading.